budget deficits are still 2 trillion plus per year. That's stimulative policy. And also look at the credit markets. Consumer debt is at an all-time record high. Credit card debt is at an all-time record high. Household debt, the savings rate continues to plunge. Everybody keeps spending. Well, that's the fuel for the inflation. What the Fed needs to do to put this inflation genie that it let out of the bottle on purpose, right? It's not like this happened out of left field. Not only do they have to contract the money supply, which is growing again rather rapidly, but they have to contract credit and they have to change people's behavior. They have to increase savings and reduce consumption and spending. That's how you fight inflation. But we haven't done that at all. And if you go back to the very definition of inflation, which is an expansion of the supply of money, it also includes credit. Inflation is an expansion of the supply of money and the supply of credit. So credit expansion is inflationary, and we've had credit expanding the entire time that the Fed was fighting inflation, which means the fight has been inadequate. Now, why has inflation come down the way they measure it? It was 9%, now it's 3%. Well, again, nothing goes in a straight line, right? So maybe it goes 9, then it goes 3, and the next move is 12, right? It's just in a wave up. The trend is higher, right? You'd want to buy the dip in inflation, right? If you're looking at that. But the main reason inflation came down was the market anticipated all the rate hikes, and that strengthened the dollar. The dollar index rose about 30%. And in that environment, brought down oil prices, commodity prices, and the strong dollar put a lid on import prices. So that helped. We also had a small contraction in the money supply after a major expansion. But
through QT then, eh?
Quantitative tightening, yeah, which is now pretty much ending. The Fed's rate hikes are over. So now the markets are starting to look at the rate cuts, which is going to weaken the dollar. So ironically, the Fed says, hey, we've won our inflation fight. We can cut rates. By indicating that, inflation is going to come roaring back because that brings down the dollar, right? It's actually loosening the financial conditions. But I think the dollar is turning. I think it's top. It's getting ready to fall. Commodities have bottomed. Oil has bottomed. We're going to start to see a big move up. And the Fed is in a box now because it's promised the market rate cuts. It can't, pull the rug out from under it. But when inflation really surprises, the thing that's going to be a big problem is we're going to be in a recession. In fact, we're probably in a recession right now. I know the economic data doesn't say that. We just got this, big GDP number, right? 3.3%. Unemployment is really low. But they were saying the same thing in the summer of 2008. They were saying we're not going to have a recession, even though they were in one. It's just that the government data didn't recognize the Great Recession that started in December of 2007. They didn't recognize it until December of 2008. So the government in December of 2008 came out and said, you know what? All the economic data we released for the last year was wrong. All the good data was actually bad data. We've been in a recession the whole time. And they went and revised down everything. So they could just as easily do the same thing now. They could come back and say, you know what? All those good numbers that we gave you, all those jobs that we said were created, they actually weren't created. We actually lost millions of jobs. And all that economic growth that we said was there, actually, we were in recession the whole time. They could easily come back and do that. And I think it's likely that they will. And I think that the reason that Joe Biden is so unpopular, it's unprecedented how unpopular. But nobody has ever been less popular. And the same thing with Kamala Harris. She's the most unpopular vice president ever. Why? What did she do? I don't know. Could you name anything she stands for, anything she's done that would justify this degree of unpopularity? I think it's just the voters taking out their frustration on how bad the economy is. The economy stinks, and the American electorate tends to either blame or credit. So if the economy is bad, the White House gets credit. If the economy is good, the White House gets credit. If the economy is bad, they get the blame. Whether it's their fault or not, the voters are just going to vote their pocketbooks. Remember Henry Carville, it's the economy, stupid. Yeah. Well, if you want to know why Biden is so unpopular, it's the economy, stupid. right? So the economy is bad. So the media keeps saying there's a disconnect between the voters and the economy. No, the disconnect is between the data and the economy. The voters have got it right. The economy is awful.
Wow. So why not keep, or potentially as the Fed, the Ponzi going, so to speak? If the Fed starts lowering rates, or at least signaling that rates come down, now losses at banks start evaporating, start reducing the cost of borrowing, maybe start reducing some of those credit defaults, which you mentioned debt and delinquencies are higher now than where they were before COVID. So it does seem like there's some unsustainability with the spending. Even just this morning, we saw, once again, lower inflation and PCE numbers, yet higher spending. So it seems like the Fed should be in this position of cutting. Is it just your position that that will create substantial inflation again, or can we bail out the banks that way?
And remember that spending was financed in large part by a depletion of savings, which are already low. So it's more debt, it's more credit. But there's a reason that Ponzi schemes are illegal. and that's because they can't continue indefinitely. They always fall apart. So there's always people holding the bag that end up losing money. And so, no, they can't keep the Ponzi going indefinitely because it's a Ponzi by definition. Now, governments can generally get away with it a lot longer than you and I could because they protect themselves. They kind of write the rules, but they can't, suspend the rules indefinitely. And the reason I think they can't really get away with it anymore is the way they've gotten away with it in the past is by creating inflation. That's how they do it, right? Quantitative easing is inflation by definition. It's just a better name. It's a euphemism. Because if the government said our policy is to create inflation, people would, well, I don't like that. I don't like inflation. That makes prices go up. So if they just call it quantitative easing, they don't get a lot of enemies. Although in Europe, they were even more abrupt. They kept saying, or even here, we need more inflation. They actually told us that. They said the problem is we don't have enough inflation. Like, we have a lot of problems. That was not one of them. Lack of inflation is not your problem. But the government said it was, and they had to solve it by creating more inflation. So that's what they did. Every time we had a problem, they created inflation to solve it. But they've created so much inflation at this point that inflation is now the biggest problem. And how do you solve the inflation problem with more inflation? You don't. So when we get the next economic downturn, when it's going to happen in an environment where you still have high inflation, right? It's not going to be 2% or any, close to it. Now, inflation's, let's say 4 or 5%, whatever it is. And unemployment really spikes. The banks start to fail and they print a bunch more money. And now you take that inflation rate and send it right into the double digits. That's it. I mean, you're done.
How long
the dollar
away?
crashes. I mean, the bonds crash, because the bond market, remember, you look at that chart of the bond market. All the time the Fed has been doing these policies, we've been in this secular bull market for bonds, which started in 1980, 81 and ended in 2020. So you had a 40-year bull market in bonds, which is now the beginning of a bear market, which who knows how long it's going to last. It's going to be brutal. It's going to be around for a long time. So now if the Fed is going to try QE in a bond bear, I don't think it's going to work. I think the next time the Fed prints money to buy bonds, bonds are going to go down. And of course, what are really going to go down are not just treasuries, but the bonds that the Fed is not buying. Because Treasury buying of, the Fed buying of treasuries will offset some of the decline.
It should pump up prices.
Right, but they're not going to buy all the treasuries, so other people would be selling. But what about the muni bonds? Who's going to buy them? What about corporate bonds? Rates are going to surge across the spectrum, but nobody can afford to pay. I mean, just look at the national debt. This is where it screams at you. The national debt is $34 trillion. It's growing by $1.25 trillion. In calendar 2024, something like $12 trillion of that matures, has to be rolled over. In addition to the $4 trillion of new borrowing, that's $16 trillion. Who's going to buy that? Right now, the Fed is selling. Fed's adding to the problem. You know who else is selling? Social Security. They were one of the biggest buyers of treasuries during that bull market. They're now one of the biggest sellers because Social Security, because so many people have dropped out of the labor force or retired, Social Security doesn't collect enough money in payroll taxes to cover the cost of the benefits of the people who are already retired. Not to mention the ones who are going to retire next week or next month. So they're selling treasuries. The other big buyer of treasuries were foreigners, Japan, China. They're not buying. I mean, they're selling too. So this is a huge problem. It's a huge bond market bubble.
So you think there'll be a lack of buyers, and as they return to QE and increase the supply substantially of bonds, there won't be enough bond buyers.
There already isn't enough bond buyers. That's
so
why
rates skyrocket again.
That's why they're going to go back to QE. And again, the other point, interest on the national debt is about now the same as national defense. A year ago, it was nothing. It was $200 or $300 billion a year. Now it's almost $1 trillion. In another year or two, interest on the national debt, if interest rates just stay where they are, right? Don't go higher, which they could do. They just stay where they are. Interest will be more than Social Security or Medicare. It'll be the single biggest expense. In a couple of years, about 50% of every dollar the U.S. government collects in taxes, income taxes, Social Security taxes, 50 cents of every dollar will be needed just to pay the interest on the debt. Not pay back any of the debt, just the interest on the debt. And before the end of this decade, assuming that we can get there without a crisis, which I don't think is possible.
Do you think it's imminent?
Oh, yeah. Well, it's been imminent for a while. But before the end of the decade, which is not that far away, 100% of government tax revenues will be for interest on the debt. Now, obviously, that circumstances can't exist. You can't have a government that simply transfers money to bondholders and has nothing left over for anything else. I'm not talking about, not even to pay the salaries of the people that clean the toilets in the Capitol. Nothing. No money for anything except interest on the debt. So this is how much this thing is ballooned out of proportion. Even Janet Yellen, a year ago or a year and a half ago, when she was asked if she was worried about the $30 trillion debt, she said, no, the debt didn't matter as long as the interest payments were low.